Welcome back to America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates, Nolan Baker and Chaz Price. 419-794-3030 is the phone number. Website arhq.com. Have we seen the last of severe stock market slides? Analyst Eddie Gabor, well, he doesn't think so. He told Fox Business he is expecting the S&P 500 to drop another 25% in the near future.
We don't think this market has properly priced in what's happening under the hood economically. Someone has to be right. Either the bond market and credit markets are right or the stock market is right. I'm betting on the credit and bond markets are being correct and predicting what's happening here in the future.
But Gabor went on to say he's predicting a rebound in the third and fourth quarters. In the meantime, what are you guys telling clients that are, afraid of that other shoe dropping?
Well, I think people want to know what should I own before a market crash. And, the challenging thing about that is, whether this gentleman, Eddie, is correct or not. At the end of the day, the market's going to do what the market's going to do. Looking at things from a fundamental or technical standpoint, there could be some analysis that would suggest that near term the risk is still elevated. In fact, if you follow like the Nobel Prize winning philosophy of Dr. Robert Shiller, he still indicates that risk is elevated in the market based upon his PE ratio. Also, I would say, when you think about it, I have a younger child. My youngest is 16. He became a new driver in the fall of last year, and he's been out there driving around for a year now. And the challenge is even with a kid or even with yourself or when you're driving around, at no point are you going to know when a crash is going to occur. But the thing is you can take steps ahead of the time to be more adaptive. If you think about, what type of safety features vehicles have today, whether it's airbags or seat belts, mandatory, not using your cell phone while you're driving around, the way the vehicle is constructed is quite a bit different. It also is, I think, a way to be adaptive to market conditions because, when my son, who turned 16 last year, going into winter, now we didn't really have a terrible winter here in Northwest Ohio, but what I explained to him is I said, hey, if you're going down to hockey at BG and the sign outside says that you can go 55 miles an hour and the philosophy is maybe somebody drives 5 or 7 miles over that. You don't have to go 60 or 62 miles an hour if the weather is bad outside. So if it's snowing, it's sleet coming down, it's dark, it's okay to slow down inside of the car that you have to adapt to what the conditions are that are outside. So if we have these poor economic conditions on Wall Street or in the economy, the question is what you should own before a market crash is your portfolio adaptive to what the market conditions are, or is your portfolio just set on cruise control, doing 70 miles an hour regardless of what the market conditions are? Chaz, I think you point this out really well when we develop a portfolio and we're developing this investment policy statement. One of the things that we do is we oftentimes will put what I call a circuit breaker or a gas pedal in a portfolio. Mm-hmm. So when economic conditions look really good, we might be punching it and going 70 miles an hour if it's sunny and we're traveling outside and the weather's good. But when economic conditions deteriorate, we might go more defensive, increase some of our cash positions to be somewhat more defensive. So I think you do a great job explaining how to develop a process to be adaptive and what people should do before a market crash. And then you also talk about the fact of we've had a lot of people that have come in, I think recently, I can think of 2 individuals, on one who came to us for some advice after coming to one of our events and said, I went to cash in October of last year because I just couldn't take it anymore. And I now know, looking back, I wish I wouldn't have done that because we know since October the market's been pretty good. And I've seen a couple of people recently that have come in that have gone to cash. And what's the problem with just taking your money and going to cash?
It's the one thing that sets the average investor apart from the market. And so we look at these trends in the market and the average growth and percentage gain, and we say, okay, the market on average does 9 or 10% over a long period of time, but the average investor gets about 2, and it's for the exact reason that you just described, is that we're emotional beings for the most part, and I think people make financial decisions based on their gut instead of on their head sometimes, and so The emotional component of investing in money tells us to do something when we don't feel good about it. And conversely, to do something when we feel good, because that's the emotional aspect. And so generally it's counterintuitive, because when people feel bad, they sell. The market's down, and then when they feel good, they buy more, generally because they're optimistic. And so that's exactly what I think the issue is jumping in and out of the market based on emotion and based on how we feel. If we take a page out of one of the best investors of all time, Warren Buffett, this quote reminds me of this conversation, and I'm paraphrasing, but he would say, buy companies that go up, and if they don't go up, don't buy them. And obviously that's kind of I don't know what you'd call that, but an axiom or something like that. But he's right, though. And what he's speaking about is buying companies that have strong financial prospects, that have good cash reserves and are making money and have earnings. And my interpretation of that is that if you buy good companies that are making money, that have strong earnings, you really don't have to worry about the ups and downs of the market for the most part, because these companies that have the strong earnings give investors confidence in the marketplace. They generally help drive up the stock prices even when things around them are going awry, when the market's in general not doing well. And so, for instance, I looked at a statistic today, and it said the average stock in the S&P 500 right now is down, like maybe 1.75 to 2%. But when you look at the top, 5 companies, the FANG stocks, as we refer to them, the Facebooks and Amazons, they're up, wildly, up 10, 15, maybe even 20%. So, during these times when the stock market is volatile, trying to figure out what to own before a downturn, you want to really look for companies that have strong financial prospects, financial situations. They have earnings, because earnings are the life's blood of the stock market and of a company. And if we can get companies also that pay dividends, part of that growth in the earnings that these companies generate can be returned to you in the form of a dividend, or it can be reinvested into the company. But generally, retirees that are in income mode, that are looking for reliable sources of income to supplement their Social Security and pensions and other, retirement sources, dividends can be an area where it can help, do that, help you stay in the market, be a little bit more confident.
Yeah, so when you're thinking about what should I own before a market crash, again, take some lessons from who probably was one of the most successful investors of all time, Warren Buffett, as you pointed out. There's another article that Warren Buffett put together. So if you get a chance, take a look on Google and type in Buy American IM. And that was an article that Warren Buffett wrote in October of 2008. So if we go back in time, what we know is in October of 2008, the stock market was in a brutal, bad situation. The market was down, I think, at 25 or 30% at about that time frame in October. And so if you listen to his advice, what he talked about is these companies that are the cash-rich, low debt, that have a competitive advantage. These are the companies that he talked about buying. And if you followed his advice on October of 2008 and you invested, what happened is the market continued to fall over the next several months. In fact, the market bottomed out in March of 2009. So, had you followed that advice and just in the broad market, you would have been down about 25%. So you'd have been like, wow, that's probably the worst advice I ever got. I can't believe I read that article and took action on it. But had you not allowed your emotions to get involved in the investment process, and you looked at it 1 year later, so October of 2009, your portfolio would be up about 19%. In fact, if you then extend that time frame, even going through COVID and everything else that we've been through here recently, up until like October of last year, I think the S&P was up roughly 260% over that time frame. So some of those things really kind of catch you off guard, and it's so important, to know what you own before a market crash happens. We do like those cash-rich, low-debt, high return on equity companies that are daily essential, that have a competitive advantage. There's also other strategies that are out there. I met with two individuals recently, and what happened is they had all their money in the stock and bond market. So the challenge about that is they can experience years like last year, 2022, when you had both stock and bonds go down in price. So it's kind of like a 1-2 punch in the gut when you have everything going down. And so in their situation, what they wanted to do is consider having a plan B in place, not having all of your money in investments that are subject to risk. Things like you talked about, having things that are non-correlated assets, things that maybe aren't necessarily in the market. You could use the fixed accounts with how high rates are. There's things like fixed index annuities, but make sure you have a plan B in place. And if you don't have a plan B in place, I think that I would encourage you to find out about our philosophy and methodology when it comes to investing. It's called the independent income system. So while you're on Google, you could just type in the independent income system, because we give a lot more information talking about where the threats and opportunities are in the marketplace right now. And it's some more great ways to get you prepared if you're worried about an upcoming market crash.
Guys, I didn't realize we were all going to be bringing Warren Buffett anecdotes to the table today. I actually just read a biopic on him recently where he was talking about the credit of Berkshire Hathaway in the 58 years he's been doing it. He said it's about 12 great decisions over the course of that time. So one big decision, or one wise decision every 5 years or so. In layman's terms, you don't have to get everything right all the time, but you want to make sure those very important decisions you do get right. And that can seem easier said than done, especially when emotion comes into play, but that is what the team at America's Retirement Headquarters can help you with, help develop that plan to take the emotion out of it. Again, the independent income system, and just make sure that you've got something to withstand whatever may come down the line. It all starts with that phone call, 419-794-3030. Once again, 419-794-3030, or the website, arhq.com.